Good afternoon, this is Sean Golding with Golding and Golding, here to discuss the basics of how taxes impact expats. So if you're a U.S. person and you happen to relocate overseas, you're enjoying the good life outside of the United States, unless you formally expatriated and gave up your U.S. person status, such as a legal permanent resident or U.S. citizen, you're still stuck in the U.S. tax system. So one very important thing to note is that an expat, someone who's living outside of, in this case, the United States, is different than someone who has formally expatriated and filed Form 8854. Typically, U.S. citizens, legal permanent residents, foreign nationals who meet the substantial presence test are the ones who may be hit with U.S. tax on their worldwide income. So if you are considered a U.S. person, even if you live outside of the United States, you're going to be taxed on your worldwide income and you're required to report your global assets. Some very important things to keep in mind that we come across in our practice. If you have earned income from overseas, it's reportable in the United States, even if it's not sourced in the U.S., even if that income never touched the United States. So you're from the U.S., you live in country B, all of your income is sourced as a consultant from countries C, D, and E, you're still taxed on your worldwide income. Passive income pretty much works the same as well. Interest, dividends, capital gains, royalties, all of that fun stuff. Typically, that's going to be included in your income, part of your tax base. So in some countries, for example, if you're let's take Singapore, and you're receiving pension contributions similar to a 401k, chances are that's going to be taxed on your U.S. tax return. You may be earning tax-free interest, or you may be in a country in which they don't tax dividends, which is common in lots of Asian countries. Either way, all of that income need to be reported on your U.S. tax return. In addition, all of your foreign accounts, assets, investments have to be included as well. The IRS has developed many different international information reporting forms to assist you in making sure that you comply. The FBAR, Form 3520, 3520-A, the Form 5471, 8938, there's lots of them. So if you have foreign assets, investments, or accounts, you should look into the different reporting requirements. Now, with all of that said, it doesn't necessarily mean that you will owe tax. For example, you may qualify for the foreign earned income exclusion, which you file on Form 2555, in which if you meet either the physical presence test or the bona fide residence test, in addition to having the foreign country qualify as your tax home, then guess what? You can exclude the first $105,000 of income and normally around $15,000 to $20,000 of your housing exclusion if you meet that as well. The most important thing about that statement is this. If you earn $90,000 and you live outside of the United States as an expat, you still have to file the Form 1040 and the 2555. Why? Because if you don't file the form, how is the IRS ever going to know that you qualify for the foreign earned income exclusion? Lots of clients come to us, they didn't file because most of their income was passive and they were below the foreign earned income exclusion. Next thing you know, it could be a possible passport revocation scenario, because if the IRS doesn't know you have foreign tax credits and they don't know you qualify for the exclusion, then they may have you showing, a six-figure tax debt. If neither one of those apply, foreign tax credits on income you already pay tax on in a foreign country, foreign earned income exclusion, you can always consider a tax treaty position to be treated as a foreign resident, or if the only reason you meet U.S. tax is because you meet the substantial presence test, maybe you came to the U.S. more than 31 days in the current year, and when you do the 3-year synopsis, you come on the bad side, and so that you meet substantial presence, you can claim closer connection. If you've been out of compliance in prior years, you may want to consider one of the amnesty programs. They're good programs, especially for the expats. There's the streamlined foreign offshore procedures in which there's no penalty. If you're willful, it's voluntary disclosure. If you don't qualify as a foreign person, this presentation is probably not for you, but you would do the streamlined domestic. If you do reside outside of the U.S. as an expat, but for some reason don't qualify for streamlined foreign, maybe you just missed the date in terms of the 330 rule or the substantial presence rule, you can always consider doing a reasonable cost submission. We have lots of free information available on our main website, goldinglawyers.com. If appropriate, you can always reach out and schedule a reduced fee initial consultation. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day. Happy New Year.